looking at it year by year, that this is the third year of the expansion with a very aggressive monetary policy, and so we're in the part of the typical expansion where there's a lot of inflation pressures because it happened in a giant big way, and everybody's long. The world is it's the end of a paradigm because everybody believes that they want everything to go up. And of course, that creates a dynamic where policy is long, everything goes up. And of course, that happens by creating money and credit, debt, and which creates debt. And that dynamic means that you must have a decline in real wealth measured by that, because that's the financial wealth has become enormous relative to the real wealth. Everybody who's holding bonds or assets, particularly the debt assets, believes, or financial assets in general, which are just journal entries, they're claims, but they believe that they can take that buying power and sell it and buy goods and services, and they can't. And by its necessity, there must be negative real returns, negative returns relative to buying power. So if we take it chronologically, I think there's the short-term cycle, which is usually the business cycle, takes 7 years on average, and give or take, depending on where you start the cycle, give or take a few years. I think we're moving along here quicker. So we're now going to be in a very tight environment, and that changes everything. So when we look at the returns of equities, and we look at the well-being of companies, you see that the cost of interest relative to the expected returns of equities creates a squeeze on equities, changes the economics. A lot of borrowing has been done at much lower interest rates and so on. The return on equity for a company and versus the return, the cost of debt is changing, and all of those things are changing. And like all bubbles or paradigm shifts, the mentality that did exist, we don't have to worry about inflation, cash is a safe place, and so on, gets a shock. There's a punch in the face. There's been a 40-year bull market, and there's a punch in the face to all investors. We're going through it as Jeremy describes. And when that happens, things that were never supposed to happen, because everybody believes in the tech companies, and that which is the same as the Nifty 50 or the .com companies, they get hammered, right? So like you say, 75% decline in Kathy Wood's funds, and so on and so forth. That causes the adaptation. So we're in the beginning of that adaptation. That is most similar, I think, to the 1970s period. It becomes financial. So I think as we'll come to the 2022 elections, and that'll have economics and markets has a big impact. So we'll be in the 2022 elections. I think that you'll see greater political extremism coming out of that. Moderates are leaving, and even those who are running are populists. Populists are people who will fight to win and will not accept losing and will fight for their constituency. So you'll see more populism of the left and more populism of the right. So if I look at 2023, I look at 2024, and I'm worried about the neither side accepting losing. And I think that there's a big risk that that the system is in jeopardy, because history has shown when the causes that people are behind are of greater importance to them than the system is in jeopardy. Those types of things change the world landscape. I'm emphasizing the United States, and certainly Europe is in that type of a position. So I think that when I look at it, it'll be very important to not only diversify well, but to be able to be long and short different assets in order to perform well in that environment.
Jeremy, Ray just described how he's seen some of the risks ahead in terms of politics and the risks of rising debt, inflation, and the debasement of buying power. Anything else you would add to that?
Listening to Ray is that we have a market today which feels superficially like 2000. And I think it's going to play out initially like 2000. And then, unfortunately, is going to phase, as he suggests, into the 70s, where the deflationary effects on the economy and the stock market will result in a world rather like the 70s, where all assets are simply much lower priced than they are today.